What is going on? Welcome to my channel. I am the Covered Call Guy. Welcome back, my fellow income investors. And for those who are new, this YouTube journey, my goal here is to create $120,000 in annual passive income. I'm currently holding 6 Covered Call ETFs, and I will do a portfolio review at the end of the month, showing you my entire portfolio size, holdings, cash position, if I'm holding any cash, what my buys, sells, whatever, everything. All right. My projected annual dividend / distribution income is about 70 grand a year, give or take, projected. Okay, guys, don't hold me to the T on this. It's projected. That translates to about 5.8K a month, 1.3K a week, $191 per day, and about $7.99 per hour. All right, legal disclaimer before we start, though. This content is for informational and educational purposes only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Tongue twister there for me. Remember, guys, I am just some random clown you found on YouTube, and I could be completely wrong. All right, this video is going to be another update, I guess, on the Vista shares. We're going to talk about OMAH. All right, so this was actually one of the holdings I had before. I sold it off before I made the YouTube channel. I had about, like, give or take about maybe $10,000-$15,000 in it, but I sold it off before I made the channel. But we're going to talk about it because it looks like there are some discussion about it, and yeah, you know, when you're talking about if it is the 15% yield trap, right? We're going to be talking about, you know, what's behind it. Are you liquidating principal disguised as passive income, right? So I'm going to expose the exact mechanics of how these funds manufacture yield at your expense, or probably not at your expense. Depends on how you view this and how you play it with your portfolio holdings. All right, so I just want to get this out the way. If you understand this, then you do understand the institutional reality. Okay, so these are not traditional dividend stocks. Okay, they are a volatility monetization engine. Okay, you are selling your upside insurance to market speculators. Okay, if you do not understand where the yield is coming from, then you are the yield, right? All right, so let's talk about the ugly truth about your yield. Okay, so if you're buying this because you think Warren Buffett is suddenly paying 15% a year, well, he isn't, right? You got to expose the hidden mechanics of this fund. You are not buying the stock Berkshire stock, right? You not Berkshire, right? You're not buying that. So understand that, okay? You're not really investing like Mr. Buffett here. You're kind of just imitating it to your best because it is delayed, right? By the time you you know, they buy, sell, and they showed you the holdings, you're kind of like you're like 3-6 months behind, right? So let's look at the 3-layer engine here. The first one is the equity base. Okay, so it is anchored to Berkshire Class B, and it's roughly the top holdings, about 20 top holdings. So this creates a value heavy, structurally low volatility core. How you want to play this depends. It's good. How you want to play this, it depends. It's bad. The second layer is options overlay. Okay, this is where the real engine, where your yield and your premiums coming from, right? So they actively write calls option, converting market volatility and time decay directly into cash flow. Okay, and the third layer, this is where the distribution comes from, right? They target a massive 15% annual yield, and they pay you monthly, right? Completely regardless of underlying price movement. Okay, let's look at the consistency paradox here. They have been very, very consistent in paying about 1.25% monthly target yield, okay? And if you observe this, then your observation is factually correct. They engineer this to maintain stable payouts every single month, okay? But, okay, I want to say this is a policy-driven income, not organic yield from Berkshire Hathaway. Okay, just understand that part. You are not investing in Berkshire. You're not investing like Warren Buffett. You're not doing anything remotely close to it, okay? It is entirely manufactured, not earned. You are imitating pretty much at least 3 months behind. Okay, let's look about the low volatility paradox. What do I mean by that? Well, OMAH targets a massive 15% yield using low volatility Berkshire base, right? So this is a mathematical contradiction here, because they must extract maximum income from stable assets, right? Leaving zero margin for error in spread management. So that is probably very, very difficult to do if the market conditions is not right. So if the option premium shrink or the market trends upward rapidly, well, then this math kind of breaks apart. Okay, what is the key man risk, right? So OMA carries a highly unique succession risk that is entirely absent in broader market funds. Okay, so its performance is intricately linked to Berkshire Hathaway's leadership transition from Warren Buffett to Greg Abel. Okay, Warren Buffett is officially retired. He's done. Right. So one bad headline or wavering sentiment during this transition compresses this fund's NAV permanently. What is the alpha engine? Well, it's in three parts, right? The first part is, first, you sell the call. For those who are new to the income space, especially using covered calls, right? This is how you make your money. You sell the call. That means you collect cash from speculators. If the market stays flat or declines, you keep the premium. The second is buy protection, right? Purchase a higher strike call to prevent total mathematical annihilation during a violent rally. So you at least capture anywhere from 2 to 5%, right? And the third, right, this is the hidden cost, right? You do cap your upside. That is the part of the trade-off for income. You're not really going to get away from this. Right? You're just not. You're going to have to find another hedge, perhaps an uncapped growth stock to kind of replace the growth, right? So if the market rips, you're holding a 1.25% monthly payout while the underlying index doubles here. Okay, being the house, right? So the better advantage here is that instead of mimicking one billionaire's 13F filing, right, you can at least see and compare SPY and QQI leverage the massive liquid beta of broad market indexes, right? They're the house, right? Dynamically adjusting the odds based on real-time market fear. Okay, volatility harvesting. So in rich premiums environment, they sell fewer options further out of the money, right? So they hit the distribution target while keeping the upside uncapped when the market recovers. This is very, very important. This is how the house always wins. Okay, let's look at the rock illusion. Okay, return of capital here. So let's talk about SPY because we will be comparing OMA to SPY. We will be comparing OMA to QQI, right? So 98% of SPY's yield is return of capital. What does this mean? In traditional finance, return of capital, ROC, means a fund is cannibalizing itself. However, understand the difference because here it is your greatest tax weapon, okay? It lowers your immediate tax burden by reducing your cost basis. So you defer tax indefinitely until you sell or your cost basis hits zero. Okay, let's look at the institutional arbitrage here. And what do I mean by this? Well, to circumvent punitive taxes, SPY, QQI, and OMA uses broad-based macro index option. So under this, they use section 1256, right? So realized gains are automatically taxed at a highly favorable 60-40 long-term, short-term split. So combined with aggressive internal tax loss harvesting, this helps offset legally, which forces cash distribution to be tax deferred ROC, right? So this is exactly how institutional money avoid tax drag. Okay, what is the slow motion liquidation, right? So this is why, you're gonna have to look at OMA because this could be a trap. Okay, I view OMA is flirting with targeting 15% on low volatility base here. That could be the trap here. That's why I'm a little iffy on it. I used to own it, sold out of it, and if the strategy works and I'm still keeping my eye on it, I might get back in, right? It is a decent 15% yielder. But yeah, this could be the trap here because if the underlying Berkshire equity fails to appreciate faster than the distributed premiums, well, constructive ROC here becomes a destructive capital drain, right? Earning a massive yield while your principal bleeds out is a slow motion liquidation of your own wealth. Okay, let's look at total return reality. Okay, so let's look at 1 year total return of SPY. It did almost 16%, right? But stop, all right, stop here. Stop looking at isolated prices. Okay, SPY dominate the passive S&P cover call index by over 650 basis point. Okay, the active strategy works. And OMA, well, its underlying Berkshire base recently took a negative 7% hit while the S&P ripped 18%, right? This is the cost of your safety. All right. Outperformance explained. Well, if you're going to talk about, well, what happened here? Why did it outperform? Why did BRK drop, right? You notice that BRK goes down while OMAH goes up. This feels abnormal, right? It's like, this is crazy, but it's explainable, okay? Why did this happen? Well, because Berkshire Class B is pure price return with no dividend. So it's leaving it fully exposed to the downside, right? This is the math behind it. You have to understand the math behind it. So OMAH continuously collects option premiums regardless of the stock price, right? So total return equals income plus price, which partially offsets your downside and allows OMAH to exceed the underlying in flat markets. That is the math behind this. Understand the math behind it. That's very important to understand. It's like, oh my God, why is OMAH doing it better than BRK? Well, this is why, right? It's nothing crazy, right? The hidden trade-off, right? So understand your hidden trade-off when you are buying OMAH, or for the most part, almost all cover call ETFs, right? Your upside is absolutely capped, okay? Any gains above the strike price are sold away to fund your yield, okay? Barron, if you read Barron's explicitly notes that this strategy works best in flat or down markets, but severely underperforms in strong bull markets. Why? Because you sacrifice explosive upside for immediate income. All right, that is the ultimate goal here. All right, let's choose your sacrifice here. All right, so QQI is the high beta play, right? So offers highest theoretical return by riding secular tech, right? With massive yields here. But you will endure severe drawdowns when tech multiple compresses, okay? This requires iron stomach here, okay? If you love the QQI, just buy more. Why would you choose QQI over OMAH? Well, OMAH is the upside sacrifice, right? It does protect you when tech crashes, providing a value-based buffer, right? That's why people invest in Buffett's companies, right? However, you violently underperformed during a broad bull run when you, because they sold your gains to fund your yield. So, it does protect some buffer, some a better downside percentage, right? But this is the trade-off here you're gonna have to give up. Let's look at the cost of admission, right? As you can tell, if it's OMAH is expense ratio compared to SPY QQI, it is the highest, right? You ultimately you're paying a 27 basis point premium to mimic a 13F filing, right? Execution here has to be flawless. It has to be, okay? Then again, right? These aren't passive index funds. You are paying for active options management here. Okay, let's look at OMAH versus the Titans. As you can see, OMAH, right? The engine here is Berkshire Top 20, targets a 15% yield, right? Brutal reality here is that I think they are trying to squeeze water from a stone, okay? It takes on massive concentration risk into a fund to fund a rigid payout with low beta stocks, right? Zero margin for error here. Whereas SPY, come on, it's the undisputed king of core replacement here, right? And QQI, yes, I made fun of it. It is the degenerate tech engine, right? But it's one of the best, right? It's QQI. If you're thinking about buying the Qs, this comes to mind always, right? SPY owns the core, QQI owns the growth. OMAH is more, in my opinion, a highly specialized contrarian wedge here. So it's not that you shouldn't own it, but when you own it, you have to understand like where does this play in my holdings. Okay, strategic allocations here. Right, again, out of the three, SPY is the core, right? Retain essential exposure to broad U.S. economy. This is your anchor point, right? QQI is the satellite if you want to have it rotate around for growth and, because it translates massive tech volatility into yield, right? Keep sizing strictly limited unless you want to play the Qs, that's fine. And then OMAH is the stabilizer here because it does trying to mimic Warren Buffett, right? It is a little bit more deeply defensive, right? It is a value ballast for when you believe tech is in a massive bubble. So it does hold up a little bit slightly better. All right, that is all. This is hopefully you got something out of it, informational, creative, funny. You learned something new. Perhaps I introduced you to it, the Vista shares or OMAH, if you haven't known about it. But yeah, their motto is invest like Warren Buffett, but take that to a grain of salt, because again, you're not really investing like Buffett here, right? You're mimicking a 13F following, and you could be a lot of things could change by the time the next one comes out. So again, if you're new, thanks for watching. Thanks for supporting me. And for those who subscribed and been supporting me for the longest, I appreciate you too. And if you haven't, leave me a subscribe. Give me a subscribe. Leave a comment. If you haven't, leave a comment. If you haven't liked it, leave a like. Appreciate you guys for watching. Catch you guys on the next. Stay tuned.